Welcome to Treasury One's weekly market review. Now, last week we watched Russia. This week it's France, where nightly riots and looting events have popped up in some places, including Paris, following the death of a teenager at a roadblock. Now, although events may be losing steam, fears remain that similar flare-ups could spread, and it is all reflective of how flammable some parts have become due to social inequality, income disparities, and xenophobic trends in parts of the world. Back in South Africa, President Ramaphosa's Phala hangover continues. The Office of the Public Protector recently decided to clear the buffalo of all wrongdoing, saying most of the allegations were based on hearsay. Now, the report has raised eyebrows, and some are already questioning whether the report will hold up in court. That's if someone decides to take it under review. Now, whether guilty or not, the ruling party will likely seek to drag the process along to avoid any solid developments in the case ahead of the 2024 general elections. We should also remember who brought the matter to light in the first place. Spy boss Arthur Fraser, a known Zuma ally, which is just to point out that this was an intentional political maneuver from the president's internal opponents. In other local news from last week, the quarterly employment survey revealed a further 21,000 jobs lost over the first 3 months of 2023, likely due to a combination of factors as well as load shedding, which is undermining job creation. Then, in its annual report, the SARB has expressed concern about increasing commercial bank exposure to government debt. That's as the state's finances continues to deteriorate as the power crisis take its toll on the economy. It should come as a warning to foreign investors to price their positions accordingly, and being aware that not all risks are instantly visible. Some may be tied to sinking state-owned entities and others to municipalities struggling to stay afloat. Now, speaking of central banks, the gathering of central bank chiefs at the ECB's annual conference in Portugal were closely monitored for any signals on monetary policy. Now, both the ECB and Fed indicated that they were approaching their terminal rates. The Bank of England hinted at more hikes to come, while the Bank of Japan gave no reason to believe its loose monetary policy is going to change anytime soon. Although the Fed is preparing the market for further hikes to come, recent US data suggests that the bank will not need to hike rates by the full 50 basis points it signaled in its most recent dot plots. The unexpected drop in the PCE core deflator released on Friday supports this. In fact, there has been a flurry of better-than-expected economic data, which reveals surprising strength in several corners of the US economy. And while an eventual recession in the US is still the base case, this recent data suggests that one isn't imminent, let alone a foregone conclusion. Now, meanwhile, despite the stronger disinflationary impulse revealed by last week's latest inflation figures, it's still too soon for the ECB to lower its guard. There was a smaller than expected uptick in core inflation, which suggests that underlying price pressures may be starting to ease, but more will be needed for the ECB to turn less hawkish. Chinese authorities remain upbeat about the country's rebound, telling WEF delegates that economic growth will be higher in the second quarter than the first, and China will hit its 5% target despite recent weakness. That's all good and well, but for now the data continues to show a lackluster economic performance, with last week's declining manufacturing PMI again revealing a struggling manufacturing sector. This in turn raises questions about the global growth outlook and prospective commodity demand. This performance raises the likelihood that the state will deliver more stimulus in coming months to reach that 5% goal. Looking at the rand, after the currency showed signs of blowing out against the US dollar late last week, it reversed back below the 1880 mark on Monday. Now, the technical patterns established are more of a reversal pattern and suggest that a short-term top has been achieved. Investors will be reluctant to adopt any clear-cut directional momentum while we're waiting for important data releases towards the end of the week. Speaking of which, markets will be looking at June's Fed minutes out on Wednesday for further guidance on the central bank's rate decisions. 2 sets of labour data will also be released this week that will add further colour to the rate picture. ADP employment numbers are out on Thursday, while June's non-farm payrolls will be available on Friday. And after 14 consecutive months of coming in higher than consensus expectations, investors will be closely watching this month's figure to see if hiring activity in the US is finally slowing. The persistently tight labour market has traders pricing in at least one more 25 basis point hike this year, and should the data surprise to the upside, it will keep bets on higher rates entrenched. Then Germany will release its factory orders for May this week. The rapid monetary policy tightening globally is weighing on demand for German industrial goods. So declining factory orders therefore pose a significant risk to Germany's economic recovery prospects in the coming quarters. That then the week that was and the one to come for the markets.